Our next guest coined the term bond vigilantes. He said that they did back off last week, but could return over concerns about the federal deficit and political gridlock. Joining us now is Ed Yardeni, president of Yardeni Research. He also said, Ed, that maybe it doesn't supplant the angst about interest rates, but oil, with the geopolitical concerns, oil could become more important in determining which direction the markets are moving at this point. But you still think bonds we could see the vigilantes come back with $33 trillion in debt?
Well, yeah, I think so. They're not necessarily done voicing their concerns about debt and the deficit. Just because we had this tremendous rally in the bond market last week, doesn't mean that problem's gone away. Clearly, one of the main reasons that we had that rally last week is the Treasury recognized that the bond market wasn't happy with all the supply, and they cut back on the supply. So that was just a very short-term response to that. In addition, we've had some weak economic indicators, and it looks like the Fed is done. So the bond vigilantes are not the only players in this bond market, clearly, but they're not gone.
Well, it's nice to be able to cut back on supply. But that's not going to work forever. There's going to be a certain amount of supply when you're talking about $33 trillion. There's going to be a large supply that needs to be issued.
Well, absolutely. I mean, look, Janet Yellen could just, I guess, finance everything in the bill market and hope that short-term rates go down rather than go up or stay high. But the reality is, one of the most disturbing things about the deficit and the debt is that it's kind of compounding as interest rates have gone up. Because we've got so much debt, we're seeing that one of the biggest outlays now in the government is just paying interest. And so that's not going to go away. They're going to have to continue to pay their interest.
We haven't seen much in terms of, the oil market has been oblivious to the biggest events in the Middle East in 40 years, probably. Why?
Well, it is a bit of a head scratcher because there is a lot of concerns that the war between Hamas and Israel will turn into a regional war. I guess the market figures that if somehow Iran's oil production or oil exports get disrupted, I mean, you'd kind of imagine that the Biden administration, which loosened up on some of the restrictions on sanctions on the oil coming out of Iran, that they would tighten things up pretty aggressively here. But I guess everybody figures that the Saudis would start pumping some more to keep the price of oil from going up. I think the Saudis learned so far this year that the market just isn't going to be able to handle $100 oil. China's weak, Europe's weak, the U.S. Is relatively strong, but maybe slowing down somewhat. And then, of course, the consumers demonstrated that, once the price of gasoline goes up, guess what? they drive less, and a lot of people are working from home, so they don't have to drive as much. So I think you're making a very good point about watching the oil price as an indicator of just how concerning the Middle East war is in terms of its geopolitical impact, but also in terms of its economic impact.
Well, we never know whether it's supply or it's always both, obviously, but whenever it moves one way or the other, we're not sure what to attribute it to. At this point, you still think the Fed can successfully land this baby and it'll be a soft landing?
Yeah, I think that's been the contrary scenario. Nobody ever believes the Fed's going to get it right. As long as they don't say mission accomplished, I think we'll be okay. As long as they don't jinx it.
A banner is saying it's one thing, but.
Yeah, so I think they're actually getting it. I don't want to say mission accomplished, but I think they're getting their soft landing.
And then what does that post-soft landing look like? 2%? I mean, with $33 trillion in debt and permanently higher interest rates, let's say, what does that get us?
Well, right now, as you said, the obvious conclusion is not much. I don't think it gets us a recession, but it's certainly hard to see how the economy keeps that pace of the third quarter up. 4.9% is just not sustainable given the points you just made. However, one thing I'm quite optimistic about is productivity. Productivity could be the the surprising variable, the surprisingly positive variable. It was very strong in the third quarter, following a quite strong second quarter productivity number. And as we all know, there's a labor shortage, and companies are solving that problem with technology. So productivity could be the surprising variable that gives us better than 2% growth.